Now, the important thing about residual income is that first things first, the clean surplus approach has to apply. If it doesn't apply, then you cannot use this evaluation technique for a company. So what this thing is going to ask you to do, it's going to ask you to work out, when it says residual income, I mean, the conceptual thing around that is that you've got the book value of the company. Okay, so that's on the balance sheet, the book value. Then what it's asking you to do is it's asking you to work out how much additional return or residual income this thing is generating from the current book value. Okay, and the book value changes obviously over time. Given the fact that there's a charge on this. So another way that you can think about this is economic value added. So if a company, let me just give the conceptual framework here. If your return on a company, if your return on invested capital, if the percentage, your ROIC, is 8%, and your weighted average cost of capital is 10%, and it goes like that into the future or into perpetuity, then the management team is destroying value of the company, because your return on invested capital is lower than the charge, the weighted average cost of capital, the required rate of return in that case. Okay, that's one way to look at it. Alternative way to look at it is that if your return on equity is, let's call it 10%, and your cost of equity is 15%, the same thing. These guys are destroying value going forward, because they should be getting 15% plus a year, but they're generating 10%. So what this thing is trying to determine whether these guys are adding value or whether they're destroying value. I mean, it's the same thing with how you work out free cash flow and so on, but meaning from that you want to determine the value of the company, but that's a very basic way to think about it. What additional return is it giving you above what's required? Okay. So basically it's an opportunity cost type of method to do it. Okay, so residual income is equal to net income less the charge for capital, common shareholders' equity cost to generate that income. Okay, so residual income after consideration of the cost of the company's capital. So how much additional return is this thing generating above what is required? Okay, now there's two approaches you can do. You can either do it via the cost of equity, or you can do it via the WACC method. Okay, the weighted average cost of capital. So approach one, economic concept, residual income deducts the cost of equity capital from the net income. This cost of equity capital equals the shareholders' opportunity cost, also known as the cost of equity. Okay, so cost of equity. The cost of equity charge is marginal cost as it reflects the cost of additional equity that is generated internally and by selling more equity interest. Now, what does that mean? It means that as this company generates more capital, as it generates, let's say it doesn't pay out anything, the formula is the book value at the start, or equity at the start, plus the net income minus the dividends, which in this case is 0, this example. That'll give you the book value at the end of the year. Okay, and that's very important because, first of all, that's a clean surplus approach, so that has to hold for this thing to work. And the second thing that's important about that is you're going to use those book values into the future. Because if it gives you, like, if it says the ROE of the company is 25% for the next 3 years, and it gives you the beginning book value, then by having the book value, the starting equity book value, okay, and it tells you 25%, you can work out the net income. Think about that. What is ROE? ROE is net income divided by equity, in this case book value. So you can work out what the net income is. And if it gives you the payout ratio, then you can work it out as well. Then what you need to do, you need to add, so book value at the start, so year 0 or today, plus the net income, minus the dividend, equals book value in year 1. Okay, and you go, and it goes forward and go forward and it goes on. Okay, that's the first concept that everyone needs to get. The book value changes over time. The second thing that you need to get is that you're working out firstly what the EPS is every single, or the earnings, either the earnings for the entire company or EPS, depending on what the question is. And you can work that out, like I said, by the ROE, and if you know what the starting book value is for that year. That's the second thing. The other thing that you need to understand as well is that given the fact that this book value is changing every single year, you have got a certain charge every single year When it comes to book value of the equity, obviously you've got the cost of equity charge every single year that you need to do. So that charge changes every single year. So year one, let's say you have 100 million book value, and you've got a 10% equity charge, then the opportunity cost that you're going to charge to the EPS is going to be 10 million. If your earnings for that year was 12 million, it means that your residual income for that year was 2 million. 12 million minus 10. This is all accounting stuff. Okay. Next year you've got the 100 million plus the 10 minus whatever dividend, let's say it's 0, so plus 12, not 10, plus 12. And that'll be beginning book value in year one. Notice that 112 million multiplied by your 10%, so now your equity charge is 11.2 million. Everybody with me on this? Okay. And then what will happen is, depending on what the earnings is, let's say it's 30 million, great, and you've got a residual income of that year of 1.8 million. Okay. Then you carry it over. It keeps on going. Okay, and there's certain ways of, we're going to go through, like what's the persistence factor and all that stuff, and we'll go through that in the notes. I just wanted to give you guys a rough idea. That's the one method. That's approach one. Approach two looks at the entire funding structure again. Now we get back to that column, and we're going to work out the weighted average cost of capital. But the important thing about that is that it's not using earnings, it's using net operating profit. So it's very similar in the way that it looks at it, but there's a slight change when it comes to what you're going to use. And obviously you're not going to use cost of equity, you're going to use weighted average cost of capital to determine your capital charge. Okay, and that's the debt plus equity cost for the company after tax operating profits. So very, very closely related to ROIC. And that's why I said if your ROIC is above your WACC, the company is adding value, or it's generating value for the shareholders. And why is that? Because you know that your residual income into the future is higher, is positive. Okay, everybody get that? Okay, it's kind of, I know it's spoken here a little bit, but we will go through an example too. So this whole thing has got to do with economic value added, because you're adding value to the company as time goes on. And market value added is a concept that you're basically adding value to the company's market value. Because if you think about it, if the guy's got the price to book, and this is something I just want to touch on as well. If your book value, once again, clean, simplest approach is relative. If your price to book is 1, what that means is that your residual income into the, I'm talking about theoretically, your residual income into the future is 0. But you're not adding any value, you're not destroying any value, it's 1. Okay. If it's more than 1, then you're adding value to the company. So if your residual income into the future is positive, then your price to book has to be more than 1. And if your residual income into the future is negative, it means that you're destroying value. So that's if it's negative. Now the important thing around that is that, remember, you start with the book value. That's the bulk of the valuation, or of the valuation you're determining, because it's B0, so the book value today, plus all the residual incomes into the future. Okay, we're going to go through a few examples. I just want to touch on this before we get into the examples. Okay, so question: if net income of the equity is 1 million and the total capital of the entity is 2 million, finance 50/50, and the cost of income is 10%, what is the residual income? Okay, now let's start. Net income. That automatically tells me that we're going to work with cost of equity. Okay, why does it say? Because we don't have the net operating profit or anything like that. We've got the net income. Okay, second thing is total capital 2 million, 50/50 financed. Okay, in other words, 1 million is the equity. Okay, it's not 2 million, it's 50% funded. And we know the cost of equity is 10%, so let's go through this. The charge is 2 minus 1 million, because that's the equity, times 10% is equal to 100,000. Okay, the net income was 1 million. So 1 million minus 100K is equal to 900 million residual income. Okay, that's what it should tell you there. There's an equity charge to the net income. There's a capital charge to the net operating income after tax. Okay. Here's the EVA. EVA is equal to no PLAT, or no net operating profit or loss after tax, minus the capital charge times the total capital. So that'll be your equity plus your debt. So in this case, it would be, in this example, that would be 2 million, and obviously your charge will be slightly lower than your cost of equity. Okay. Everybody with me so far? It could happen, but in a very short period. In a very short period, it could happen. Residual income models can be used for equity valuation, commercial implementation, measurement of goodwill impairment. So that just gives you an idea of if the thing's generating more or less. Okay, that's self-explanatory. I'm not going to go through that. Okay. Now to go through the actual, the formula itself. Okay, so the model analyzes the intrinsic value of equity as a sum of the book value today, B0, plus all the present value of the expected future residual incomes. So how much additional it's generating to perpetuity. So just think about what this thing is saying. It's saying that if this thing is going to keep on generating the same amount, if the ROE of this company is going to be equal to the R, or the cost of equity, it means that the book value today is going to be the same going forward. That's basically what this model is saying. So if it's adding value, great. So it's almost like saying if your realized return on the equity is higher than the expected return, these guys are going to generate value. That's basically what this thing is saying. So let's look at the clean surplus approach. BT, your ending value of your equity, important thing, book value there. There's a relationship between the net earnings, the dividends. We're not taking into account share purchases or anything like that. It's saying that the book value at the start of the year plus the earnings minus the dividends gives you the ending book value in the year. Okay, so everybody got that. That's like super important. That's the entire thing around this. Okay, so the condition that earnings reflect all changes in the book value of equity other than ownership transaction is known as a clean surplus accounting. Guys, this thing doesn't work for a lot of companies. It works for a few financial companies, and the problem that you also have is that the book value for a company, especially companies that do a lot of share buybacks, have got negative book value. It doesn't work if your assets and your liabilities are fairly valued, so it's almost like fair value accounting, then your book value tends to be very, very accurate of what it should be. And that's why banks tend to try and price to book, but if you go to a company like Tiger Brands or any of those companies, it's not going to work. Okay. So first approach, value is equal to book value of the equity today plus the residual incomes into the future discounted back by the appropriate time and discount rate. Okay, so what's the residual income? EPS minus the book value times the equity charge. What's the equity charge? That's the cost of equity. Okay, and you're going to do that for year 1, 2, 3 going forward. Okay, then the residual income approach 2, and this is the easy one because you're just adding back the additional that you're going above it. So ROE minus the required rate of return, so cost of equity, times the book value at the beginning, where book value is equal, well, you know what the book value is. Okay, then the value is equal to today's book value, plus the ROE minus required rate of return times the book value divided by 1 plus R. So that's the additional, it's just a different way of saying what it's getting. These two are basically the same. Okay, just using slightly inputs. Because what does ROI, to get to the, what does RI, how you get to that, it tells you how much more you generate above the required rate of return, and in this equation, you're just calculating directly what you generated more than required rate of return. It's exactly the same formula, it's just expressed slightly differently. Yeah. Well, they assume BT is like just one back. So yeah, you can assume that's basically what you're gonna beginning value. It's just well, it would have been strange if you said 1 minus 1. It's the same as, but I just think that BT, because you can work it out for every, because remember you're carrying it forward the whole time. I think that's why us put it in like that. But it means basically B0 for our calculation. Okay. Let's go through a question, guys, because the more we practice this, the better we will understand it. Okay. stock has a current market price of 52 and required rate of return of 11%. That's your cost of equity. So let's just, cost of equity equals 11%. The book value per share is 12 at the end of the current year. So B book value 1 is equal to 12 at the end of the current year. I assume it's B, that's B value. That's probably B0, sorry, not. The consensus annual earnings estimate for the following 2 years are $2 and 2.2 respective for year 1 and 2. The annualized dividend per share forecast 50 and 0.55 for years 1 and 2 respectively. What is the forecast residual income for year 1? Okay. Year 1. Let me do this way. That's year 2, okay? So book value is equal to, we said, 12. So let's just call this book value end. Book value start, and this is div. Okay, so this is 12, carried over 12. EPS was 2. Dividend was 0. And okay, so then we have book value. So that's going to be 13,5. 13,5, 2,2 minus 0,55. What is that? This is where basic arithmetic is. 14, let me just do this. $15,15. Okay. Now the important thing here is that, okay, so what is the forecasted residual income for year 1? Now the important thing is we know that the cost of equity is 11%. Okay. Is everybody still with me? Before I continue on this wonderful journey. Okay. Okay, so my charge on this thing, my charge is always on the beginning book value on this thing here. So my charge in year 1 is going to be, okay, this is 11%, so my charge is going to be 11, it was 11%, right? 12, this was 13,5, 11%. So if I multiply those two, I get 12 times 0.11 is equal 1.32, and if I multiply 13.5 by 0.11, I get 1,485. Okay, this is my charge. This is the minimum that I need to get. So if I get that, anything above that on EPS, then I have a residual income. So now to determine my residual income, I'm going to take this amount, 2 minus that. It's going to, so 2 minus 1,32, and I'm going to take 2,2 minus 1,485, and I get these amounts. You guys get that? Did you guys understand what I did there? Let's go through it again, or you guys? Okay. The main thing, you have to work out, the important thing about this is when you get this, you have to work out the beginning book value of every single year. That's why I had to go through this graph. So 12 plus 2 minus 0.5, that carried over. So that's going to be your start that you're going to calculate your charge that you need to get. And then obviously once you've worked that out, then you need to work out what the residual income is because you have your EPS. Okay. Okay. Then the fundamental determinants of residual income. No assumptions about future earnings and growth are made. If we assume constant earnings and dividend growth, we can derive the formula as follows. So your book value today plus, once again, your ROE minus your required rate of return. So that's going to be the additional percentage that it's going to generate for you, divided by R minus G times your beginning book value. Okay. To get the, it's basically to get you the additional side. The thing that people forget about this is that they tend to forget to add the beginning book value. That is where people get tricked up on this question, because they always like they work out this whole thing, especially with this example previously. So let's say you do work it out, guys. Once you've worked this out, by the way, you need to discount it back to present value. Okay, that's important because that's where once again you can get that wrong. But even if you do work out this and you work out a exit value, what's important about that is you need to add your beginning book value. Okay. Another way they can trick you in the exam is they tell you the price to book in year 3. So you're going to use that as your exit value. In year 3, the price to book is estimated to be 2. So you work out your price to book on year 2, and then you discount that back. But the problem with that is you shouldn't just discount that back automatically. You need to deduct the beginning book value as well. Okay, that's important. Why is that important? Because you can't add the beginning book value twice. Because once again, it's path dependent. Starts with the beginning book value, it grows. That book value already has the book value at the beginning in play. Okay. Then moving on to Tobin's Q. Okay, so all that Tobin's Q basically means is what's the market value of the assets divided by the replacement cost. And it's actually quite difficult to just, you need to actually get the proper market value of the asset, so it's not easy to get that. But Tobin works with Tobin works with replacement cost of assets, i.e. inflation, as opposed to historical values. So you actually need to adjust the values of the assets that's on the balance sheet. And the thing that's interesting about this, once you start to do this, just out of interest sake, because that's how people can manipulate earnings or manipulate ratios. If you have got assets that are stale pricing, very old, but it's generating nice revenue or nice operating profit, then your ROE is going to look massively high compared to what it should be, due to the fact that you've got a very low equity base. Because obviously, once again, you're accounting assets is equal to equity plus liabilities. Okay. You want to see if you're okay. The reason why you want to do this, it's how easy is this thing to replicate. Okay, so if you think about Richemont. Richemont's got very nice brands. It's got Cartier, it's got very nice watch brands, etc. Those watch brands are not truly reflected on the balance sheet because they generate higher, their ROICs are much higher than obviously if you just use it on that. But to replicate a brand like Cartier, it's going to cost you a hell of a lot of money. Okay, and if you can generate that ROICs by doing the same advertising and getting the same artisans and everything, and you can get those higher ROICs, you can get value for your shareholders, then you're going to do it, and they're going to keep on doing it over and over and over. So it's almost like a barrier to entry. How much will it cost you to generate the same revenue by trying to do the same thing? Okay, so if you just have to put up a factory to make bread and you can make lots of profits on it, you'll do it. Okay, how much does it cost to do this? That's basically what they want to see, if they can generate more profit from it than the cost of doing it. That's essentially why we do something like that. And that's a formula. Market value of debt and equity divided by the replacement cost of total assets. Okay. So RMLs can be used to estimate justified values. Guys, you can go through this. The price to book is essentially book value today plus the ROE minus R divided by R minus G times the book value, obviously. Okay. I can go through that. Okay, so this is again the single stage model. Guys, remember this. The majority of the value sits in that term there, book value today. That's where the majority of it lies. Okay, then let's go through an example. Assume the following: ROE 17%, long-term growth rate 9%, required rate of return on equity 12%, opening book value 10 million. So 17 minus 12% divided by R minus G, 12 minus 9. You multiply that by 10 million, and you're going to add 10 million as the starting point there. And you're going to get to this thing. In this case, because these guys perpetually generated ROE above the R, that residual income was actually higher than your starting book value, which is very, very good. If you can generate ROEs perpetually above your required rate of return, that's a very good business to be in. But what will tend to happen is that the price to book on that company will tend to be quite high. So in this case, what is that? That's 26 divided by 10, so that's a 2.6 price to book valuation. Well, fundamental price to book valuation. Okay. That's fine. Okay, so the standard residual income value formula. Book, okay, guys, it's over and over and over. I mean, it's like, guys can go through. That's just to work out the thing. Now, the more important thing about the continual residual income. So, what's the probability that this company can keep on making positive residual income into the future? So, there's a few assumptions that can be made. So, the example we just did assumes that the residual income continues indefinitely at a positive level. Okay, if that happens, it's a phenomenally. That just essentially means that the company's got a very, very good competitive advantage, and it keeps on generating profits for its or value for its shareholders. Okay, if the residual income is 0 from the terminal year onwards, that means that ROE is equal to R, so it's going to go down to a point, and then the price to book is going to be 1. Then the other one is the ROI declines to 0 as ROE reverts back to R over time. Okay, that's fine. So it'll take a long time to get there, and ROI reflects the reversion of ROE to some level of mean. So maybe you still get a positive ROE, but not massively. Okay, maybe it's one of those sectors where the guys just don't. It's just too much of a hassle to build additional capacity, and the guys don't want to do it. Now, when it comes to the persistence factor, what the persistence factor is trying to tell you, it's trying to tell you that between 1 and 0, if the persistence factor is 0, that essentially means that there's no competitive advantage thing. There's not going to be any future residual incomes in this thing. If the persistence factor is 1, it means that this thing has got some proper competitive advantages. Maybe it's I don't know, maybe it's a Facebook, or maybe it's something that just keeps on growing. It's got a huge addressable market, and it's going to generate lots of profit from it. So that's kind of what the persistence factor means in real life. Like if the persistence factor is 1, it means that these guys can keep on generating ROEs above the R. If the persistence factor is 0, it means that the competitive advantage is going to be completely eroded away. It could mean that. It could mean that, yeah. But it could mean that. But what tends to happen is if the R is very high, it's got more to do with the risk of the asset. Okay. Okay. So the equation of the continuing residual income multi-stage model is as follows: book value today. It's always starting with the book value today, plus the present value of stage 1, plus the present value of continuing. Guys, you've seen this before. It's like a 2-stage dividend discount model. So there's going to be a certain phase that's going to grow quickly, and then it's going to normalize into a mature company. Okay, and this is the present value of that's what you're going to exit it at the continuing residual income valuation. So the process, start with the current book value as we've done before, book value today, work out the residual income for the initial growth period, which is going to be higher than the normal or the continuing one, and then lastly, calculate the present value of the continuing residual income at the time period T minus 1. So you're going to work it out at time period T, discount it back 1 year, it's going to be at time period T minus 1. So the same thing, score and growth, D1, discount it back, you're going to get to D0 at time period 0. So this is the formula. There's going to be residual income in year T, so let's call it year 4, divided by 1 plus R minus W, so W is your persistence factor. Once again, if your persistence factor is 1, then your denominator is going to be small, which means that your terminal value is going to be high. Okay, that's how this thing works. And once again, once you've done this, it works out the value. Like I said, let's say it's residual income in year 4, it's going to work out your terminal value in year 3. Everybody have that. Okay. Okay, we're not going to go through that one. Okay, so the value when using residual income normally occurs earlier as opposed to the dividend discount model, which is at the end. Guys, some of these dividend discount models, 90% of the value of that thing is literally it sits in the terminal value. So very, very sensitive to that R minus G.
Just from the previous example, high ROE means that the residual income is going to increase in the future.
High IOE is a high persistence factor means it's going to stay high in the future. Yes.
So in the example, it says it's a lower persistence.
Which of the following indicates a lower residual income persistence? Okay, extreme levels of special items or accounting accruals. That's gonna not be the clean surplus approach. That's gonna violate that. So it's like it completely takes it out. Okay.
That's RI, that terminal value. You still have to
Yeah.
discount it.
Yes. Yeah. Yeah. That's why. So you work if RI was in year 4, you're gonna work out the terminal value in year 3, and then you need to discount it back by 3 years.
So that's technically not the present value because you still have to discount it.
It says present value in year t minus 1. In year t minus 1. So in year 4 minus 1 is 3. And then you still need, so it's right. It just means that you still need to, yeah, further to 3 years. But that's why it says t minus 1 and not t. So, okay. That's fine. I want to go through an example. Which of the following statements? Okay, that's not. Okay, the strengths and the weaknesses. Guys, the terminal value doesn't make up a lot. Information is readily available. You guys can go through this. I think we've drilled into the thing. Like the main thing about this valuation technique is that most of the values in B0, and if the clean surplus approach is correct, then you can. And once it's quite nice if you can just do a persistence factor. You can put it in. You can say, you know what? I think these guys have got a fairly good competitive advantage, but it's not great. Let's put a persistence factor of 0.5 in. I mean, it's not exactly the best way to think about it, but the main thing is if it's got a very, very good competitive advantage, then the persistence factor would be 1. Okay. Most appropriate to use when a company doesn't pay dividends. Company's free cash flows are negative, which happens a lot, and uncertainty exists in forecasting the terminal value when using the present value approach. Okay, and then obviously least relevant if the clean surplus approach does not hold. Okay. And here are some of the violations and accounting issues. So once again, clean surplus, we've rolled that in. Balance sheet adjustment for fair value. Intangibles not occurring. You guys can read through that. That's not necessarily too difficult. And is that it? Okay. Guys, what I just want to touch on quickly. Okay, so book value, start, EPS, div, book value end. That's how you're going to do this thing every single time. So year 1, this is book value at the beginning of year was whatever, 10. Your EPS was 2. Your dividend, you didn't pay a dividend. You add those, you get to 12. Carry it over. 12, whatever, 3, 0. You get to 15. Carry it over. 15, whatever EPS, etc., etc. Once you've done that, you go and you say, okay, my cost of equity is equal to whatever, 10%. I take the 10% times the 2, so that's going to be, sorry, I take the 10% times the 10, sorry, that's going to be 2. 10% times 12, 1.2. Wait, no, that's 1, sorry, 1.2. And here's going to be 1.5. So your cost of equity is now the same. After you've done that, you deduct your EPS from your charge, and that'll be your residual income. Once you've done that, you've worked out your residual incomes, whatever it is. Let's say X, X1, X2. You're going to discount that back by 1 year, that back by 2 years, that back by 3. So this is in T1, T2, T3. And that'll give you a value for your RIs. You still need to exit this thing. You're probably going to exit this thing on whatever the residual, whatever the persistence factor and so on. So let's say you take X2 as your value that you're going to exit this thing on. So X2 divided by 1 plus R minus whatever the persistence factor is. Let's call it 1. And let's say that was 10%. So you're going to say X2 divided by 10%. And you're going to get the terminal value in year 2. Now, the important thing about this, as soon as you do that, You need to forget about the term in time period 3. Okay, if you do that, if you're using year 3's residual income, that's growing 10%, whatever, you need to completely exclude that now. Okay, so what you're going to do now, you're going to say, okay, let's call this terminal value. So terminal value plus the x1 plus the x1 residual income, and you're going to discount that back by 2 years. And you're going to discount this thing back by 1 year. Okay, you're going to add it together, and you're going to add the beginning book value as well. Okay, remember this x2 is a residual income number. It's not, doesn't include the book value of any sort. Okay, if they do ask you to calculate the book value of some sort, like the book value in year 3 is price to book is 2, and you need to exit, you work out the book value in year 3 is, let's say this was at the end, was 17. 17 times the 2 times price to book will give you the 30, whatever, 34. Okay, you need to remember to take off the beginning book value on that, of that thing, because it shouldn't be reflected in that. Okay, and discount it back. Okay, that's residual income in a nutshell. Any questions, guys?
Because just on the weakness of residual income model, the last point,
Uh,
it says that it assumes cost of debt is directly reflected. Why is that assumption?
the cost of debt is
Directly reflected.
because the cash flow and the accounting is 1-to-1. That's what I think. That's what they mean. Just where is it?
The weakness last point.
Well, the last point. Residual income assumes that cost of debt is correctly reflected in income statement by interest expense, because your cash flow of your debt and your reflection can be different. Because of amount, it's like a variety of reasons, amortization and so on. So they assume it's a 1-to-1. Yeah. Yes. Yeah. So what happens? So the reason why you do that is you need to essentially you can't double count for it, because you're adding the beginning book value again. So if your ending price to book is going to be a certain number, you can't have that and add it again. It's like you're double counting for it. No, you should subtract it at the end. I'm talking about, okay, I might have confused so the beginning book in that formula, what it is, it's the beginning book value plus all the residual values, present value. Okay, but now what you're doing is in that present value of future stuff, you're exiting this thing, this company in year 3, and that's how you determine the terminal value by using this thing. But you can't use that and the beginning book value and add them together. So what you should do, it's kind of the same thing. Like you're basically subtracting it at the end and you're adding at the start. So it'll cancel out. But I just want to make sure that guys remember to do it at the beginning. Always add it. Doesn't matter what it is, the beginning book value. But if they give you a price to book at the end, you need to still take it off, because it'll just. I'm not communicating this effectively, guys. If the beginning book value, so you've got 2 years, just 2 years, beginning book value is 100, and you grow that book value, okay? And at the end of the book, the end period book value is 15. And the guys say the price to book is 2. You're going to deduct, sorry, you're not going to deduct the B0, you're going to deduct the 15. So if the price to book is 2, you multiply the 2 by the 15, you get 30, and you deduct the 15 from the 30. And that's what you're going to present value back, and you're going to add the B0 to that. Okay. Well, I think I communicated that incorrectly. Okay.
If you don't add the B0 in the beginning, and you discount the full value.
It's going to be wrong. No, it's going to be wrong. So B0 plus the present value of all the RIs. So in this case, it'll be maybe for 2 years, plus the exit. If the exit is, so year 1 and 2, here it was 12, so that's your ending. Let's say it's 17 here, and the price to book is 2. Price to book is 2. You're gonna multiply those with each other. It's gonna come to 34, and you're going to minus the 17 because you've already reflected that 17 in your present value of residual incomes. And then what you're going to do, you're going to discount the 17 back by, I think it's probably going to be 2 years. And you're going to take your residual income for year 2 and 3. You're going to present value those two. And you're going to add your B0, which is going to be whatever, 10 or 12 or whatever it was, at the beginning book value of this thing. So you've already taken account the growth in the book value by the residual incomes.
So if there's X is 0, so that means no terminal value.
There is a terminal value, but it's not. It's going to, yeah, it's going to, your terminal value is going to be the residual income at that divided by 1 plus R. But this is, guys, it's a different principle, this, because they're giving you a multiple instead of the residual incomes. Slightly different way of doing it. Okay. Any questions on residual income?
We have a question for, in our edge reading. Is there any questions that actually test?
Yeah. Yeah. There's lots of them. There's
For
different.
RI.
Yeah, for RI. Yeah, for RI, definitely. Okay. Okay, guys, let's run through the rest of the stuff. That was one of the more difficult readings, so that's why we wanted to look at that. Okay. So compare public and private companies. Which one do you want? Let's do free cash flow. Okay. You guys want to do free cash flow? Let's do free cash flow. Okay. Perfect. Let's do free cash flow and then we can take a break. Okay. So free cash to the firm. Cash flow from operations after tax. Guys, the important thing about this specific one, it's cash flow from operations before any working capital adjustments has been done. Okay. Another way to look at it, think about it as not CFO, but as operating cash flow. So before any of the working capital adjustments has been made. Okay, that's very, very important. Then you deduct from that the increase in working capital, and you also deduct the capital expenditure. And that's basically what's going to represent the money that you can pay the funders of the company. So that's going to be your debt guys, and that's going to be your preference shareholders and your equity guys. Okay, so you discount the free cash for the firm back by weighted average cost of capital. Okay, weighted average cost of capital, we've gone through that. If you're doing free cash to equity, you're going to discount it back by cost of equity. Okay, so market value of debt is deducted from this number to arrive at the valuation of the company's equity, because you've worked out what the entire company is worth. So you deduct the debt, the market value of debt, and you get to basically what's left for the equity guys. The interesting thing about this is that there's a few adjustments as well. If you actually see it in the market, they also do adjustments for pension liabilities and all that stuff, but you guys don't need to worry about that. Okay. The difference between free cash for the firm and free cash for the equity is basically your debt repayments, as well as it's your interest, and it's your because the interest is paid to your debt providers, okay, and also obviously as well your any of the principal payments that you're going to make to those guys. So that's where the net borrowings come into place. Because you're starting at CFO. So that's why I said, if you look at this is it's a bit confusing. So if you look at a cash flow statement, a cash flow statement is made up of CFO, CFI, and CFF. And in the CFO, it's made up of operating cash flows, and then it's got working capital changes and whatever else, and then at the end it says CFO. So it's a little bit confusing. Yeah, exactly. Yeah, so guys, it's slightly, the one is before working capital changes, the one is after working capital changes. Okay. So that's that. So when looking at the free cash flow approach from an ownership perspective, we say that the acquirer has the ability to make changes to the firm's dividend policy. They can basically, if you're the owner of the company, you can determine what the cash flow from operating, investing, and financing activity, you can determine those policies. That's why when you use this type of valuation technique, it's more from a controlling shareholder perspective. Okay, that's why you would want to look at that. Other reasons is it might be a low dividend paying company. It might be, there's a variety of reasons. You guys can read through that. Okay, I want to go through that. Okay, and here it comes from the way that you compute it. So free cash flow to the firm, Net income, add back non-cash charges, that's your that's your depreciation, that's your profit from whatever, loss from whatever, amortization, etc., etc. You add back your interest expense times 1 minus your tax rate. That is extremely important. Okay, that tells you what the tax, that's the tax shield essentially. Now the reason why you add it back is because the debt guys are part of the cash, the guys that are supposed to receive cash flows from the free cash flow to the firm. It's basically working out the cash flow for the entire firm, which is the equity and the debt holders. Okay, so that cash flows belong to those two entities. Then you deduct your working capital, you deduct your fixed capital investment, and you get to your free cash flow to the firm. Okay, when you go to the free cash flow to equity, there are two major differences. The first one is you do not add this back. Why don't you add it back? Because free cash flow to equity is to the equity holders. The equity holders have to pay back the bank their dues. That's where the interest comes into play. And then obviously this is an additional term, the net borrowings. Are they going to pay back some principal or whatever? So I would want to say those are the those two are basically the main things that differ. Then computing it from the cash flow, as I said, the cash flow is made up of 3 cash flows: CFO, CFI, and CFF. You're going to get the CFO, that's after the working capital change and stuff has been taken into account. You're going to deduct your fixed income investments, and you're going to add back your interest times 1 minus your tax rate. Once again, it's for all the capital providers, not just the equity guys. It's going to be different for this side. You're not going to add back the interest times 1 minus the tax rate, but what you are going to do is you're going to deduct the net borrowing. You're going to pay back principal. If you raise debt, you're going to add that to that cash flow. That's why you see FCFE is sometimes a lot more volatile than your FCFF. Okay. Then computing it from EBIT, you're going to say EBIT times 1 minus the tax rate. Okay, that's great because what you take into account there automatically is the interest side, because the interest is already added to that. Okay, you add back the depreciation and you take off the fixed capital investment and the working capital investment. Once again, free cash flow to equity, you're going to do EBIT times 1 minus the tax rate, add back the depreciation. You're going to deduct the interest times 1 minus the tax rate. The reason for that, once again, you've already paid the debt guys their funding, and you just go sit with the equity guys, and then same as the previous example. I think it's the next page. But EBITDA is the one that's more complicated. Guys, here's an example. You guys can go through that. The main thing is if you use the formulas that we just gone through, you're going to get to the right answer. So it's not too much of an issue. Okay. Okay, so forecasting. Where is the EBITDA one? I'm sure it'll come up. I'm sure it'll come up. Okay. So approach 1, simplest approach would be to apply a constant growth rate to the current levels of free cash flow. Guys, once you look at this stuff, it's going to be exactly the same principle we use for the dividends. Okay, so but the difference with the dividends, obviously, you're going to use weighted average cost of capital. You're not going to use cost of equity. That is a big difference in this stuff. Okay, so you're going to either grow it or a constant one, or you're going to actually model this thing. And when you model it, the important thing is going to be the debt ratio. And the reason for that is obviously it's got to do with the tax shield, which has got to do with the interest times 1 minus the tax rate. So that's the thing that's quite important. Okay. No. Free cash flow approach, look at the valuation from a control perspective. We've mentioned that already. That's minority. Dividend stock repurchase are ignored. That's very important because they can ask you that in an exam. Leverage has a small impact on FCFE and no impact on FCFF. That is not technically correct. Okay, it has a very, very small impact on FCFE because of the tax shield. Okay, but the difference between the two, the leverage doesn't impact FCFF if let me just think. I mean, it depends on the ratios and stuff, but it has a very, very, very small impact, but it's got a very big impact for FCFE due to the fact that If your leverage goes up, it's considered an inflow in that net borrowing term that you're adding
So the small effect on FCFF is
because of the interest. It's very small, guys. It's not a lot. It's very small.
Then why is it that FCFE is not appropriate for to value a company that's going to have a change in their capital structure?
Because there's massive inflows or outflows on a capital structure. So remember, what happens with FCFE, it's, if there's a change in capital structure, then either you're going to raise a lot of debt or you're going to pay down a lot of debt. So it's either going to be a massive inflow or massive outflow, which is not really going to be, it's not a normalized type of thing. So this is maybe a good question in the exam. If a company, if you've got control of the company, you're going to change the capital structure, the valuation methodology that you do want to use is going to be FCFF, free cash flow to the firm, due to the fact that that net borrowing term is going to be very big for those two. And it's not nice if your stuff has got lots of volatility in it. Okay. Okay, now EBITDA. Okay. Must be careful. Okay, so EBITDA is a really crap measure for cash. Doesn't take into account investment in firm, fixed income, etc., etc. But now, how do you determine free cash flow to the firm from EBITDA? And this is where a lot of people get a little bit confused. So, how are you going to do it? You're going to say EBITDA times 1 minus a tax rate. So exactly the same as EBIT. You're going to add depreciation times the tax rate. I'll go through a very, very brief example. Minus the investment in fixed income. Fixed capital, minus the investment in working capital, and that will give you FCFF. Let me spend 4 minutes on this quickly because people tend to get this thing wrong very quickly. Let's say the EBITDA is equal to 120. Your DA is equal to 20. Okay, so obviously your EBIT here is equal to 100. Let's say working capital investment is equal to 10, so that's negative 10. Fixed capital investment is equal to, let's call it 20. Okay, what else do we need? Okay, tax is equal to, let's call it 20%. And your interest is equal to, let's call it 10. Okay. Okay, EBIT times 1 minus the tax rate. Okay, well, let's do free cash flow to the firm. Okay, so let's do EBIT and EBITDA. Okay, this is 100 times 20%. Let me just do this quickly, sorry. So this is going to be 80. That times 1 minus the tax rate is equal to 120 times 0.8, 96. Okay, we're going to add back interest. 1 minus tax rate. We've already done that, so we don't need to do that, sorry. It's part of EBIT. Sorry, I just want to do this depreciation. Depreciation times the tax rate is equal to 20 times, okay, so that's going to be 4. Because you add that back. Okay, then what we're going to do, we're going to say less fixed capital, less working capital. So fixed capital in this one was 20 and working capital was minus 30. Minus 30. So that's going to be 70. Okay, that is according to that. Okay, so that term itself is the one that's very different now because you're multiplying that by the tax rate. Okay, now let's just go through this. The EBIT, 1 minus the tax rate, so we start there. We're going to add back the full depreciation and we're going to deduct the fixed capital and the working capital. Okay. So in this case, we're going to deduct these as well. So minus 30, and we're going to add back the 20. And what do we get to? 70. It's the same answer. Okay, so we worked out the free cash of the firm, two different methodologies, and we get to the same answer. Okay, the main thing that you need to remember about EBITDA is that you have to take the depreciation and to multiply it by the tax rate. Okay, it is a bit,
Because it's the actual tax saving from the depreciation. Or
yeah.
how to interpret
Okay, so the way I would interpret that is that you're essentially, that's tax deductible. That's the way I would think about it. Like a depreciation is a tax expense. That's how I would interpret that. Okay. Well, you only adding back the depreciation times the tax rate. Say again. The tax shield is to do with the interest. I mean, it's a similar concept, but the interest is usually when they refer to a tax shield, they refer to the interest stuff. Yeah. Yes. So depreciation times the tax rate if you go from EBITDA to your free cash flow to firm. Okay. Guys, work through a few examples. I mean, that's if you can see that this is it comes to the same answer. That's the one thing I wanted to, because people tend to get confused when it comes to this. Okay. And then net income is a horrible proxy for cash flow. You guys can go through it. And then the various models. Guys, this is a copy and paste from the dividend discount model stuff. The only difference is not cost of equity, you're using weighted average cost of capital. So present value, etc., etc. Remember, if you're using free cash flow to equity, you have to use cost of equity. If you have free cash flow to the firm, you're going to use weighted average cost of capital. And then important thing as well, and this is how they can trick you up. If you're working out the free cash flow to equity and you do this present value method, then what's going to happen is you're going to work out the value of the equity. If you're using free cash to the firm, you're going to work out the value of the firm, so you have to deduct preference shares and debt if you want to get to the value of the equity. Okay, that's how they can maybe trick you up as well. Okay, and this is, once again, it's exactly the same. It's the same formulas that we used before. Okay. Okay, guys, you can. I don't know. Do you want me to go through this? Got that. Okay. Okay, I hear you. Okay, sensitivities, high beta, so higher growth, positive for the company. Increase in profit margins, positive. If you have a higher beta, that's negative because it increases your discount rate. A higher risk-free rate, negative because it increases your discount rate, which decreases your value. High equity risk premium, that's negative because it increases your discount rate. And high growth rate, that's positive. Okay, that's basically the sensitivities. Okay, you guys know what this is. That's not a problem. Okay, and overvalued, undervalued, you guys know what that is. Okay. Okay, guys, let's take a. Do you guys want to go on? 5 minutes, and then we'll continue.